In 2001, the seventh largest company in America, crowned by Fortune magazine as the most innovative company in the country 6 years in a row, went from $90 a share to 26 cents and then to zero. 20,000 people lost their jobs, billions in retirement savings evaporated, and the entire empire was brought down by one polite question from one journalist. How exactly does this company make money? This is the Economics of Enron. Subscribe to Crisis Economics for more. And hold on to the fact that should scare you most, because we will settle it at the end. The machinery that destroyed Enron was not hidden in some basement. Most of it was reviewed, signed, and approved by regulators, by auditors, by lawyers, by the board. The scandal is not only what was illegal, it is how much of it wasn't. Enron begins boring. In 1985, two pipeline companies merge in Houston, and a preacher's son named Ken Lay ends up running a business that moves natural gas through steel tubes, solid, dull, profitable. The transformation arrives in 1990 with Jeff Skilling, a McKinsey consultant with a simple, genuinely brilliant idea. Stop being a gas company. Become the market for gas. Enron would stand in the middle of every trade, buying from producers, selling to utilities, writing contracts on energy the way Wall Street writes them on currencies. Deregulation was sweeping through American energy, and somebody was going to become its stock exchange. Enron got there first, and for a while it deserved the applause. Then it learned to count every dollar that merely passed through its trading floor as its own revenue, which is how a Houston pipeline firm suddenly out-earned IBM and AT&T on paper, reporting $100 billion of revenue in the year 2000. The stock became a cult. In late 1999, the market we opened in our .com episode, Enron launched Enron Online, a web platform that ran hundreds of billions of dollars in trades, started a business trading internet bandwidth itself, and rebranded from energy company to technology company at the exact moment the market paid any price for that word. Enron was soon trading at some 70 times its earnings, a valuation that assumed perfection forever. It hired accordingly, vacuuming the top of Ivy League classes, paying like Wall Street, and cultivating a self-image that later gave the definitive book and film their title, The Smartest Guys in the Room. The culture became a knife fight. Under the internal ranking system, employees called rank and yank, the bottom 15% were fired every review cycle. The lesson every survivor learned was make your numbers always, whatever it takes. Now open the machine, because the real product Enron manufactured was earnings. Tool number 1, mark-to-market accounting. In 1992, the SEC granted Enron, the first non-financial company ever, permission to book the entire projected profit of a long-term deal on the day it was signed, based on Enron's own models of the future. Sign a 20-year energy contract today, declare 2 decades of hypothetical profit this quarter. When Enron struck a deal with Blockbuster to stream movies into homes in the year 2000 over dial-up, it booked around $110 million of profit from a pilot project that never worked and a deal that died within months. The profits were imaginary, but the bonuses and the stock price they produced were extremely real. And notice the trap this creates. If you book 20 years of profit today, next quarter you start at zero. The machine must be fed a bigger deal every quarter forever. Growth stops being a result, it becomes a requirement of the accounting itself. Tool number 2, the shell galaxy. Enron created thousands of subsidiaries and special-purpose entities with names straight from the movies its executives loved. Chewco, after Chewbacca, the Raptors, after Jurassic Park, LJM, after the initials of the chief financial officer's wife and children. That last detail matters because the CFO himself, Andy Fasto, personally ran and profited from the entities doing business with Enron, pocketing at least $45 million, and Enron's board twice voted to waive its own code of ethics to allow it. Under the accounting rules of the day, if outside investors held just 3% of one of these entities, its debts vanished from Enron's balance sheet.
So billions in debt were parked out of sight, and losing assets were sold to the shells at friendly prices so the losses never touched the earnings. A third trick ran through Wall Street itself. Big banks handed Enron billions in loans dressed up as energy trades, so-called prepays. So borrowed money arrived on the books disguised as healthy operating cash flow. Best of all were the hedges. Enron insured its risky investments with the Raptors entities whose ability to pay was backed by Enron's own stock. Read that again. It was insurance against rain written on an umbrella made of rain.
As long as the share price rose, the magic held. If it ever fell, every trick would detonate at once. And the referees? Paid by the players. Arthur Andersen, one of the world's 5 great accounting firms, collected $52 million from Enron in 2000, $1 million a week more of it for consulting than for auditing. Wall Street analysts kept buy ratings on the stock while their banks collected Enron's fees. As late as October 2001, with the company visibly bleeding, most still said buy. Meanwhile, in California's botched deregulation of 2000 and 2001, Enron's traders gamed the power grid with strategies they nicknamed Death Star and Get Shorty, helping trigger rolling blackouts in the richest state in America, and getting caught on tape laughing about the money they were taking from grandmothers. That is not an accounting trick. That is a culture. If this kind of machine opening is why you're here, that's what this channel does every week. One subscribe keeps the series coming. The unraveling starts with a question. In March 2001, a young Fortune reporter named Bethany McLean publishes a piece with the heretical headline, "Is Enron Overpriced?" built on the observation that nobody, not even the analysts recommending it, could explain how Enron actually earned its profits. Skilling calls the question unethical. Executives fly to New York to complain to her editors, but the question does not go away because there is no answer. In April, on a live earnings call, an investor asks why Enron alone among financial firms cannot produce a balance sheet with its earnings, and Skilling responds with an insult we have to bleep. CEOs who are winning do not talk like that. In August 2001, Skilling himself resigns after just 6 months as chief executive, citing personal reasons, having sold tens of millions of dollars of stock. Days later, an Enron vice president named Sharon Watkins sends Ken Lay a memo warning that the company could implode in a wave of accounting scandals. She is ignored. Then, gravity. October 16. Enron announces a $618 million quarterly loss and quietly deletes $1.2 billion of shareholder value tied to Fasto's entities. The SEC comes asking. Fasto is fired within a week. On November 8th, Enron confesses the unthinkable. Its profits going back to 1997 were overstated by nearly $600 million. The past itself gets restated. Now, the death spiral you know from our other episodes. The stock falls, which cripples the shells backed by the stock, which triggers clauses demanding immediate repayment, which nobody can meet. For 3 weeks, a white knight appears, hometown rival Dynegy agrees to buy Enron and save it, until Dynegy's accountants get a look inside and walk away. The rating agencies who had kept Enron at investment grade through all of it finally cut to junk on November 28th. 4 days later, Enron files the largest bankruptcy in American history, $63 billion in assets, a record it holds for exactly 7 months, until WorldCom. On paper, to the very end, the auditors had signed everything. In Houston, Andersen employees were running the shredders. Count who paid. 20,000 Enron workers lost their jobs, 4,000 of them marched out with boxes the morning after the filing. Employees had been encouraged to stuff their retirement accounts with Enron stock. On average, 62% of the 401k plan was Enron shares, and during the final collapse, a plan blockout locked them out of selling for weeks while the price fell off a cliff. More than $2 billion of retirement savings burned. In late September, with the ship visibly sinking, Ken Lay told employees in an online forum that the stock was an incredible bargain and that he himself had been buying
while over the previous year, he had quietly sold shares back to the company for tens of millions. Days before the bankruptcy, Enron paid $55 million in retention bonuses to about 500 executives, while laid-off workers were initially copped at a few thousand in severance. And over the previous 3 years, Enron's top insiders had sold more than $1 billion of their own stock. The damage spilled far beyond Houston. Public pension funds from Florida to California lost hundreds of millions holding a stock their advisors called safe. The people with the least information held to the end. The people with the most were long gone. Even the city wanted its name back. The Houston Astros paid over $2 million just to strip the word Enron off their brand new stadium. Now the twist I promised. Line up the gatekeepers. The SEC approved the mark-to-market accounting. Arthur Andersen signed the statements. Elite law firms blessed the structures. The board waived its own ethics rules twice. The banks didn't just watch. They built many of the vehicles. And years later, Citigroup, JP Morgan, and CIBC paid over $7 billion to Enron's shareholders to settle their role, admitting nothing. The rating agencies held their investment-grade seal until 96 hours before the end. Enron was not a fraud that defeated the system. It was a fraud the system was paid at every checkpoint not to see. And the scoreboard of justice is stranger than you'd think. Skilling got 24 years, later cut to 14, and walked free in 2019, insisting to the end that Enron was a healthy company killed by a market panic, an argument the jury heard and rejected. Fasto, the architect, traded testimony for 6. And Ken Lay, convicted on every count, died of a heart attack before sentencing, which, under American law, erased his conviction entirely. Legally speaking, the man at the top of Enron was never convicted of anything. Andersen was, and the verdict collapsed a 90-year-old firm and tens of thousands of innocent jobs, only for the Supreme Court to overturn the conviction in 2005. The ruling was reversed. The firm was not revived. What changed forever? The Sarbanes-Oxley Act of 2002, Washington's direct answer to Enron and WorldCom, made CEOs and CFOs personally sign their company's accounts under criminal penalty, walled auditors off from consulting riches, and created a new watchdog over the accounting industry. I didn't know stopped being a legal strategy. Retirement law changed too. Workers won the legal right to diversify out of their employer's stock, so no one's pension could be chained to the company ticker the way Enron's people were. Financial journalism rediscovered its teeth. Whistleblowers got real protections, and a generation of investors learned to treat one specific silence as a siren. If nobody can explain where the profits come from, that is not a detail that is the answer. The question would be asked again, of Bernie Madoff, and of a crypto empire called FTX, which propped up its balance sheet with a token it had invented itself, the Raptors, reborn. Smartest guys' stories this channel will get to. Today, the very name is a punchline. In 2024, the Enron brand was literally bought and relaunched as a parody company selling a fake home nuclear reactor, because that is all the word is worth now. And one last twist of the knife, verified this month. In 1999, Enron spun off its oil and gas fields, the boring part, too dull for the world's smartest company. That cast-off, EOG Resources, is worth about $70 billion today, roughly everything Enron was at its peak. The pipes and the wells were the real company all along. The innovation was the accounting. Crisis Economics takes these machines apart one at a time. Subscribe so you are here when we open the next one.